So why are you coming back? Why are you doubling down on this? If you've been wrong once, why risk it twice?
Yeah, so with technical analysis, there's kind of two schools of thought. There's trend and relative strength, and there's mean reversion. And generally, we're a fan of trend and relative strength. Stick with what's working. But there comes a point when every trend gets a bit too extended, a bit too exhausted, and we think that's where Caterpillar is now. For perspective, it's about 25% above its 200-day moving average. It's also about 25% above its 200-day when you look at it relative to the S&P 500, and that's really the part that concerns us. That's about as extreme as it gets over the past 20 or 30 years. So at a minimum, we think it's a poor risk reward relative to the market, but in absolute terms, it's looking a bit vulnerable to us as well, despite the fact that, as you mentioned, we did flag it several percentage points lower. I just also highlight that the name has a history of kind of getting over its skis compared to the rest of the market. In the middle of 2008, for instance, it hit an all-time high just before the broad market rolled over, and even back in the 2002 bear market, in May of 2001, it hit a 52-week high just as the market was starting to roll over. So that's kind of our thoughts there.
I hear you talking to that, and I'm wondering if you take this as a proxy on the overall market right now, of a market that you think is overextended, and it's reflected by the likes of a Caterpillar, for example, as many people start to suggest buying industrial stocks.
Yeah, I think that's a great point. And let's remember, Caterpillar is in the Dow. It's one of the biggest weights in the Dow, as it's a price-weighted index. What's remarkable about the Dow, we just came off, over the last 3 months, the Dow outperformed the S&P by 7.7%. Since World War II, we've only seen 8 other occurrences where that's happened. 7 of the last 8 times, or actually the last 7 times that's happened, the S&P has been down about 6% over the next 4 months. So it's tended to happen at inflection points. If you think about, the start of new bull markets, you don't see that being led by the Dow Jones Industrial Average. You see, you see the opposite, in fact. And the last 2 weeks have kind of gotten people, to really change their tune. And it's amazing if you look at how sentiment has flipped over the last 2 weeks. But from our perspective, all that's done is kind of reset what you had at the end of last year. So, we still think this is a bear market rally. We're seeing some signs with breadth improving off the bottom. Some people call it some breadth thrust, breadth surges, but it's just too little at this point for us to really change that view.
All right, fair enough. That's our breakdown. Our breakout is biotech, right? XBI. What does the chart tell you there?
Yeah, so biotech's been, in a very tight trading range for the last really back to last September, if we're talking about the XBI, which is more equal weight. Just started a breakout last week. Now in bear markets, in broad bear markets, breakouts have a tendency or a possibility of failing. But we think as long as its XBI is above kind of 84, 85, that constitutes a valid breakout. We have higher conviction, though, that it's going to outperform and break out relative to the healthcare sector in general. So if you were to look at something like XBI versus XLV, we have some more conviction there, largely because, again, XBI is just starting to break out, and those defensive healthcare names that were so dominating the healthcare sector last year are starting to break down. Some of the HMOs like United Health are starting to break down. So we think there's an interesting relative pairs trade there within healthcare.
All right. We'll see you soon. Jonathan, thank you. That's Jonathan Krinsky.